I'm Tim Sustak, Chief Credit Officer with Vizo Financial, and this is your FOMC update for the September 2022 meeting. At its September meeting, the FOMC chose to raise the target Fed funds range 75 basis points to a level of 3 to 3.25%, and they also increased the rate on reserve balances by 75 basis points to a level of 3.15%. The decision to raise rates was a unanimous one by the FOMC and widely expected by the markets. There was not much change in post-meeting statement other than saying recent indicators of spending and production have grown modestly rather than that they have softened as in the prior statement. The bigger story was a new set of Fed projections that were released, which the market was looking to for a read on future rate increases. The projections show a median Fed funds estimate of 4.4% for 2022, which means we're looking at another 100 to 125 basis points of tightening over the last two meetings of the year. The 2023 median estimate shows another 20 basis points of tightening, and there's no projection for a rate reduction until 2024. The more hawkish Fed projections back up the tough talk by Chair Powell regarding inflation and likely disappointed those who had been thinking the Fed might soften regarding rates. We'll see what Chair Powell had to say about the future of interest rates in his post-meeting press conference after the break. Welcome back. In his post-meeting press conference, Chair Powell gave us an economic update as he usually does, indicating that the economy has slowed from historically high growth rates during the reopening after the pandemic, as consumer spending, housing, and business fixed investment have all seen some decline given the tighter financial condition. To the contrary, he said the labor market remains strong, with unemployment at a 50-year low, job vacancies near historic highs, and wage growth elevated. Inflation remains well above the Fed's 2% longer-run goal, and Chair Powell said that price pressures remain evident across a broad range of goods and services. It's those last two conditions, the strong jobs market and high inflation, that will keep the Fed increasing rates through the end of this year and into next. Chair Powell is emphatic that the committee will do everything it can to squash inflation. This was evident in the question and answer session of the press conference, as Chair Powell indicated that the Fed is committed to getting to a restrictive level of rates, meaning rates are placing meaningful downward pressure on inflation. He said he believes the Fed has moved into the lowest level of restrictive territory with their latest rate move, and that they still had a way to go to get to the level they believe is necessary. In response to a question concerning how the committee will know when to slow or stop increases, Chair Powell identified three conditions: economic growth below trend, a better balance between labor supply and demand, and clear evidence inflation is moving back to 2%. He reiterated many times the FOMC's commitment to bringing inflation down, and though he said that no rate path had been set in stone, he confidently said the rate path the committee ultimately takes will be enough to tame inflation. Well, I'm not sure how much clearer the Fed can make it. They are intent on fighting inflation. Based on what they know now, rates will continue to rise into next year until they reach a firmly restrictive level, and then remain there until inflation is under control. Some in the marketplace have been thinking that the Fed might soon take a pause in rate increases or flip and start cutting rates next year. Though as the chairman said, the data will dictate the future rate path. There will have to be a pretty dramatic change in data to make this hawkish Fed turn to the dove side anytime soon. That's the FOMC update for September. Thanks for watching, and be well.